Hi everybody, my name is Jeff Fowler. I'm the president of the Apartment Owners Association of California, and it is great to have us with you today for sure. And today we're going to be talking about wealth preservation through the vehicle of Delaware Statutory Trust. And before we get started, just want to mention that you can catch a live closed caption version of this on Facebook. So go to Facebook if you want to see the closed caption. And AOA, it's one of the largest individually organized groups of apartment owners here in the state of California. And our goal is always to help you succeed. And so we do that with these live streams, with the magazine. We have a help center where you can call in and get property management advice. We have the forms. There's the tenant screening that we pay a lot of attention to that, make sure that we have the very best for you and at the best price that you could imagine. And so if you're a member, definitely utilize those services and just to get the most out of everything and to be successful. And so we're hoping to give you ideas that will help you make or keep more money. And so this is one that'll help you keep more money for sure, and instead of paying a lot of taxes. And anyway, you may have missed some of the last live streams that we did. There's one about the powerful advantages of incorporating. And so you can take a look at that one from last week. It's in your member portal. It's also on YouTube if you search AOA USA. All of the videos that we do will be posted there. Not all of them, but most of them are. In your member portal, you'll have more, but you could check that out. And then we also did a member orientation a couple weeks back. And if you're a member, even if you've been a member for a while, you can watch that and see some of the updates, some of the things that we're doing now that we haven't been doing forever. And so that's a good update for sure. And on October 27th, we have the $1 Million Trade Show at the Long Beach Convention Center. That's the 27th at the Long Beach Convention Center. And definitely come up, say hi. And more than that, there are going to be so many great speakers, and you will not want to miss it. It will not be rebroadcast, so you'll want to go and you'll want to come in person for that. And we do have an in-person event in Pasadena coming up. And just check your schedule, check the seminar tab at aoausa.com. You'll see all the different seminars that we're doing. We also have an RRP class that's coming up, and it's going to be in multiple locations. We have one for Northern California. We have a couple in the Southern California area. So you may need to renew renew that, or you may need to get it for the first time. And so that is not up yet, but just know that it's coming in November. And then we are going to have a executive panel of top insurance executives, and they'll be sharing what you need to know about rental property insurance. And that's something that is really hard to put together. It's hard to gather those executives. And anyway, it should be super informative. And so you'll hear from several different companies. So that'll be really good. You won't want to miss that. And then also, if you have questions, you can just put those questions in the chat. And also, if you're at aoausa.com, there's a blue help button at the bottom. And if you put your questions in there, they'll get those questions to me. And today's event is sponsored by Cape Properties, and they have over $30 billion that they've done, just an astounding number in 1031 DST investments, which is crazy. They have over 115 years of collective experience. They're registered in all 50 states, and they are and then they have access to over 25 different sponsor companies. So they have a lot of resources at their disposal to help you to navigate the 1031 DST exchange. And our speaker today, he's the vice president of K Properties. He's in San Diego, and they have offices all throughout the state. So he has a master's in accounting. He's a graduate of the American Military University. He has 7 years of service in the Air Force Special Forces. And so it's my pleasure to introduce to you today Steve Haskell.
I'm Steve Haskell. I'm with K Properties and Investments. I'm a senior vice president over here in San Diego. Our headquarters is in LA, but we've got offices different parts of the country: Boston, New York, Washington, Las Vegas, and Washington, D.C. And today I want to talk to you a little bit about what we specialize in. It's a little niche in the real estate market called the Delaware Statutory Trust. And specifically regarding 1031 exchanges and how our investment vehicle helps our clients preserve legacy family wealth. Now, a Delaware Statutory Trust, which I'll get into, is a way for our clients to 1031 exchange into fractional ownership in large institutional grade real estate. And I'm going to get into a little more on this. But over the years, especially in the last few years, I've been pulled into meetings with financial advisors, with my clients' attorneys, and family lawyers, to help them develop plans to help bequeath their assets to their heirs. And more, we're finding that this investment vehicle, the Delaware Statutory Trust, is very conducive for that type of planning. So I'm going to get into it a little bit today for you. So how DSTs can play an important role in wealth preservation. First of all, if you have a portfolio of real estate or even just one or two properties and you're an accredited investor, you can retire from active management by doing a 1031 exchange into a Delaware Statutory Trust property. So that's a Delaware Statutory Trust property is just a trust that holds title to real estate that's held for business and investment purposes, and it defers all of your taxes when properly 1031 exchanging into that vehicle. And as I said, we're finding our clients are using it more and more to help them set up a legacy plan for their children and their heirs. In addition to the tax benefit of the 1031 exchange, you'll also realize the benefit of when the owner's passing away, the heirs will receive a step up in basis. So they won't have to pay taxes once they receive ownership of those assets. All right, so moving on. 1031 exchange, a little bit about 1031 for those that aren't familiar with it. It's a really great loophole that's been around for around 100 years or so. Originally was created for farms, and people have 1031 exchanged horses, and I've heard meteorites have been 1031 exchanged. But in the 2017, the 1031 went away for all different asset classes except for real estate. And what real estate is still allowed to do is owners of real estate can sell their property as long as it's held for business or investment related purposes, and defer their taxes, which are capital gains taxes, state and federal income taxes, the healthcare insurance tax, and in addition to the recapture of the depreciation tax. And they can defer all of that by buying a second property for equal or greater value, right? So you sell for $100,000, you buy a new property for $100,000 or greater. Now, you must buy a like kind property, meaning the property is held for business or investment purposes. Now, you could sell a house and then buy a piece of land. You can sell a piece of land and buy a self-storage facility. So it doesn't matter what the real estate is, as long as it's held for business or investment purposes. That is what makes it like kind. And the IRS has deemed the Delaware Statutory Trust as qualifying for like kind exchange in IRS Revenue Ruling 2004-86. Okay, so now going back to legacy planning, A lot of our clients are running into a major issue. The major issue is they've built up their wealth in real estate. And in Southern California, typically it's multifamily or even single family residential portfolios. Up in the Bay Area, it could be vineyards. Up in the South, ranches, Midwest, farms. But the common trend is their heirs don't want to take over that management responsibility. So our clients don't want to continue to manage it either. So they're asking themselves, what do? We don't want to pay taxes. We don't want to manage property anymore. We want to get out of all this, but we still want to have a legacy for our children or for whoever their heirs may be. Now, the Delaware Statutory Trust can be an excellent tool to satisfy this need. And as the baby boomers retire and transfer their wealth, they're specifically in real estate, they're receiving tax advantages of the 1031 exchange by being able to sell these apartments, this real estate, these buildings, these vineyards, these ranches, these farms, deferring their tax consequence, 1031 exchanging into a DST property or portfolio of DST properties, generating cash flow from those properties, able to access varying levels of debt that's built into those DSTs as needed. And we could customize the debt and the leverage in those DST portfolios to match the requirements of the investor. And they're often receiving modest appreciation on those assets. Meanwhile, it's completely passive. They're able to diversify and they're able to mitigate their time spent on managing these properties, and they're able to go out and spend more time on doing the things they love with the people they care about. And finally, when the heirs do pass away, they're able to structure into the wills the step up in basis and how the assets will be bequeathed to their heirs. I think I go a little bit into that here. Okay. So this is a very wordy slide, but I'm going to give you the gist and what I think is most important out of this. All right. So now, from my own personal experience, what I've seen and along what I've seen with many of my clients, real estate can be a point of contention when doing legacy planning. And typically, one of the parents, they have an asset, it's been in the family for a while. If they have multiple heirs, that could cause a conflict in interest where some of the heirs want to keep it, others want to manage it. They have different visions of how they want to manage that asset. They have different visions of how they want to liquidate it. Maybe some of the heirs want the money now. Others want the money later and keep the revenue generating. So that could be a very stressful and hostile situation when you're doing this legacy planning, when these assets are bequeathed to the heirs. Therefore, the DSTs have proven themselves to be a fantastic alternative. And the reason for that is because in a DST, you're able to chop up the ownership into tiny little shares, and you can distribute those shares however you'd like. For example, you may have $1 million and you may take $250,000 and put it in a multifamily complex in North Carolina. Take another $250,000, put it into a Walmart in Atlanta. Take another $250,000, put a self-storage in Texas. Another $250,000 and put it into an industrial complex in Oregon. So you have a diversified portfolio, and you own different percentages of each of these 4 properties. Now, if you have multiple kids, you can either divvy up the shares of each of the property and allocate them to each heir, or you can give each heir one of the properties. Or you can allocate all of them to one and then cash to another. And they can also strip out their ownership at different times, or however you dictate it in your will. So the flexibility that DSTs provide for legacy planning is highly conducive to having a amicable transfer of wealth when it comes to planning within a family. Once again, this slide is describing the step up in basis. So you always heard the term, you swap till you drop. Well, that's really what this is talking about. I mean, with real estate is extremely expensive to buy and sell. And if you ever pay taxes when you sell, it almost takes away the incentive for the amount of risk you take on when you go into real estate. So one of the benefits is when the owners pass away, there is currently a step up in basis in that real estate. So the taxes go away at that point in time upon passing. Okay. And so at that point, if the heirs choose to liquidate or the will dictates, then there is no tax consequence. Keep in mind, I'll have one caveat. DSTs are not liquid investments. They are transferable. What I mean by that is there's no formal secondary market. You can't press a button on the New York Stock Exchange and all of a sudden they liquidate and you have the money. It takes a little involvement. I have potentially done more secondary transactions in DSTs than anybody else, maybe in the market, anyone else that I know of. And I've only done about 6 or 7. Okay. So I've done hundreds and hundreds of transactions. So it doesn't happen often. Okay. But when it does, we send out letters to other investors in the DST, letting them know there's someone that wants to liquidate. We have thousands of investors on our platform that we can tap into. And then we find a buyer, we set a price, we settle on a price, do the transaction, and then the buyer and seller go their separate ways. But I don't recommend that if you're going into a DST to plan on liquidating in the short run. These are long-term holds. Okay, so I got through that in a fair amount of time. So I'm going to spend about 15 more minutes covering what a Delaware statutory trust is. Just so everybody knows, you have to be an accredited investor if you choose to invest in a Delaware statutory trust, meaning having a net worth of $1 million, not counting your personal residence, or make $200,000 a year as an individual, $300,000 a year as a couple. Now, if you have an entity, you can accreditate the entity as in an LLC or a trust and must have $5 million of total assets. Please consult your CPA if you have any questions about that. We cannot give tax and legal advice. DSTs are just real estate. Gains are not guaranteed. You can lose money. Once again, speak with your CPA to make sure that it's suitable for you. No guarantees. Okay. All right. So we already talked about 1031 exchange. I'm going to go over it really briefly, just to put everyone on the same page. Sell a property, business or investment related property. You can follow up by buying an investment or a business property for equal or greater value. You defer all your taxes. Super important. Now, you must use a qualified intermediary. Don't touch the money. When you sell a property, don't let it go into your bank account. It must go to a qualified intermediary account. A qualified intermediary is like an escrow. They have been blessed by the IRS to hold the money when you do a 1031 exchange so you don't pay taxes and release it to the seller of the property you wish to buy. You must reinvest all of the proceeds from your 1031 exchange. Number 3, you must buy a property of equal or greater value, as I already mentioned. Number 4, you must identify the properties you want to purchase within 45 days of closing escrow on your relinquished property. Very important. And then concurrently, there's another time clock running. It's your 180-day clock. You must close on the property within 180 days. So identify in 45 after closing, identify 180 days after closing. Here's a little graph so it'll help you remember. All right. I already spoke about this, but like-kind exchange, if you sell a rental property on the beach, you do not have to go buy another rental property on the beach. You can go buy a piece of land, self-storage, multifamily unit, you name it, as long as it's investment property, as long as it's held for business or investment purposes. All right, here's some examples of a like-kind. And now we're going to move on to DSTs, okay? So a little brief overview. Here's at the bottom here, you can see how the Delaware Statutory Trust, where you can find the ruling that approves it for like-kind exchange. Now, like I said, a Delaware Statutory Trust is just an entity. It's a trust, kind of like a family trust. But for some reason, the IRS approves it for 1031 exchange. I don't know what it is about Delaware. They must have a strong lobby. Anyways, the IRS has allowed you to sell your property 1031 exchange by buying a piece of a trust that holds title to investment property. And these typically aren't like houses or, a little parcel of land. They're typically $20 to $100 million properties. So they're large institutional grade typically. Okay. So that often provides a higher quality of real estate than most of our clients can access on their own. So some ways, yeah, it's like a limited liability company, right? Like holding a piece of real estate in an LLC. But the thing is, in an LLC, you can't 1031 exchange in or out. However, you can hold title to a Delaware statutory trust using your LLC or using your family trust. Okay. Okay, moving on. So also in a trust, this is interesting. Whatever revenues generated from the property, as an owner, you receive your pro rata share. Now, whatever potential appreciation, or just like your potential cash flow, whatever your potential appreciation takes place, you get your pro rata share. The sponsor cannot participate in the upside, in the appreciation. Okay, unlike an LLC or a REIT, often when there's waterfalls on the back end or profit sharing, that doesn't work in DSTs. So you, as the investor, are entitled to your pro rata share of any potential upside or any potential downside, and you're entitled to your pro rata share of the revenue, net of costs, like property management, things like that. Okay. But once again, nothing's guaranteed. This is real estate, and the Delaware Statutory Trust does not shelter the asset from economic conditions. Okay. You can lose money. That's why we diversify as much as possible. That's why we take on as little debt as we can at this stage in the cycle, and most of our clients this stage in their careers and their lives. Okay. When a DST is sold, usually it's 5 to 7 years. At that time, you can do 3 things. You can pay your taxes. Most people don't do that. You can 1031 exchange into your own property if you find something that you want to buy on your own. Or you can 1031 exchange into another DST. Or you do a hybrid of all 3. Okay. So there's flexibility there. Why do people invest in DSTs? Most of our clients will give you the following reasons. The trite cliche, no more tenants, toilets, and trash, right? Passive management. Number 2, you do get pros that manage these assets. I mean, these are often large billion-dollar firms, national or international level resources that are throwing attention to your assets, managing them to that level of ability and scale that often folks like you or myself wouldn't have access to those type of resources on my own. All right, number 3, allows investors to concentrate further on what really matters. So typically, a lot of times folks use DSTs as retiring from real estate. They have their portfolios, or they have their multifamily building they've been managing, and they're looking for a way to get out of it and retire so they can spend time with their family, time traveling, time on the golf course. Or what we're seeing a lot more is lawyers, doctors, professionals. They just don't have time to manage real estate on the side. So they're using DSTs as a way, as a passive option for real estate management. And then number 4 is kind of the same thing that we already talked about. So we'll move on. Okay. So here's another thing that's I mentioned briefly earlier, but through DSTs, you can diversify. So if you have that $500,000 that you just received from selling a property, the minimums are $100,000 per DST. So you might be able to put, let's see, you can spread out your equity. Number 2, number 3, put $100,000 into a multifamily building, put another $100,000 in an office building, put another $100,000 into an industrial, another $100,000 into a medical, another $100,000 into a triple net property. So with $500,000, you've diversified into 5 different asset classes in 5 different markets all over the country. Okay. Helps mitigate the volatility a bit. Number 4, in DSTs, you have the opportunity to access this large scale of real estate, often debt free. So if you don't have debt and you don't want to take on debt, but you want access to a larger, more high quality piece of real estate, we potentially have a DST for you that's $30-40 million property without a loan on it. So you don't have to worry about bank foreclosure, cash flow sweeps, cross collateralization, yield maintenance, defeasance, prepayment penalties, balloon loans, all those risks that loans bring to real estate, you can do away with if you don't need to take on debt. But we also have leveraged properties of all different loans to value, and it's built in. It's already built into the deal. It's turnkey, and our investors don't need to apply for it. They don't need to sign for it. It doesn't show up on their credit report. Okay. It's all built into the DST. And then we can talk about that later with you. Feel free to contact me or my firm to get into the specifics with that. All right. So we only have a few more minutes here. So I'm going to kind of wrap up with DSTs and a little bit about our company. At the end of the year, you get a 1099 substitute form and a tax packet. It looks like a profit and loss statement, and it goes on the Schedule E of your tax return. And that's where you can also take the non-cash expenses like depreciation, help benefit from those tax efficiencies. And I'm going to bounce over right now to a little bit about K Properties, okay? Because I got to wrap it up. I got to say a little bit of good things about our companies before we go. Okay. So K Properties and Investments, I know Jeff gave a little bit about us, but we're licensed in all 50 states. We specialize in the Delaware Statutory Trust. And many say we're the biggest at what we do at this point. And we've been involved with about 30 billion DST property. And I think we've done about over 500 million of equity this year. And with all that scale that we've accomplished, we also have been able to develop a due diligence process to help mitigate risk for our clients. In that due diligence process, we mystery shop properties. We send people out to the properties. We do we go through all the property inspections. We have commercial grade databases that do additional due diligence on the properties, look up trend analysis, comps, appraisals. We review all the third-party reports, including environmental reports, zoning, other appraisals, things like that. We do asset class rejection. So even though there's higher yielding assets such as assisted living, hotels, cannabis farms, solar farms, oil and gas, and oftentimes that attracts a lot of attention of those chasing yield, it is not suitable for our clientele. We're willing to give up the business in order to maintain a more conservative strategy for our clients. We don't want to take on that risk. It's not what we're looking for. So you're not going to find that on our platform. Again, we do mystery shopping of the properties in case our investors can't get out there. But oftentimes we will fly our investors out to the properties. We do sensitivity analysis and stress testing on the property, lease audits to make sure there's no carve-outs or opportunities for the tenant to get out of their lease early. Very important. All right. And just so everybody knows, just because we do a lot of due diligence, and no matter how many times we review it, no matter how good the deal looks, it's real estate. And something can always go wrong. Okay. So that's why we need to stick with our blocking and tackling, stay as low debt as possible, especially at this time in the market. We diversify, try to stay in good areas, multiple economic drivers, stay with sponsors that are strong and have a good track record. And then make sure that if something does go wrong, we can live to fight another day and get through any kind of potential weather that's ahead of us. Please give us a call. The number's there on the bottom, 855-899-4597. You can also give me a call. My number is 619-332-6414. That's 619-332-6414. And feel free. I'd love to talk to you, or please reach out and contact one of our registered reps at K Properties and Investments. We'll give you a free consultation, look at your situation, and develop a sample solution that can give you a visual illustration of taking your numbers, your situation, diversifying and spreading out your equity amongst a variety of different properties, and show you some potential cash flow that you receive on that in a year. Anyways, that concludes my presentation for today. 10:30, right on the dot. Back to you, Jeff.
All right. Well, thank you so much for that, Steve. Hey, can you tell me what those three T's were one more time?
Oh, the tenants, toilets, and trash.
Right. I think you missed one of the T's.
Well, what's that?
Tyrants.
Yes, like the California government.
Right.
Yeah.
So just a quick update. Earlier in the week, LA County voted 3-2 to end the eviction moratorium, and so that'll end at the end of the year. So that's news that most people probably already heard if you're in LA. But if you're in Alameda and you're like, man, when is the end coming? Well, hopefully Alameda and Sonoma and these other places that still have eviction moratoriums will also follow suit. And then just yesterday we had the LA City vote to end it on February 1st, but yet we'll see how everything plays out with that one, as there's still some things to happen there, but we'll see. But anyway, yeah, it's been tyrannical ruler, just governing the seizure of property, the rent freezes, and it's just been a tough hoe for a lot of you. And I know that some of you are probably even watching this because of all that stuff. And anyway, I do want to mention that at aoausa.com/PAC, Political Action Center, there's different ways that you can get involved. Every month we're doing a Take Action Tuesday. We're just trying to get people to do something. And I know that everybody cares about it, but doing something about it is a whole nother thing. And just like so many people in the past, fought hard to make America a free country. At the same time, we as individuals need to fight on a local and state level just to, fight. You gotta be careful with everything you say now, but to be politically active, to engage and to give feedback to city council members, county supervisors, governor, mayor, all these different people. And so we want to encourage you to do something, and because the grassroots, that's where the power is. For just AOA to post a comment or have a meeting with somebody is one thing, and although we represent over 20,000 people, still, when our 20,000 people do something, then it becomes way more powerful. And so I just want to mention that, and also mention that, one of the things, AOA, before it was ever an association, it was a brokerage and is a brokerage still. So we do have, if you're in the LA area, we definitely could give you a free property valuation, and you could feel us out and see if you want to list your building with us. And here we go. We have a lot of questions already, so that's great. And Brendan on YouTube. And so definitely, put your questions in now for sure. Brendan, what is the realistic risk that a 1031 will be additionally restricted in the next few terms? I'm looking longer term climate, not just who's going to win in the next midterm.
Yeah, I mean, when it's been around for 100 years, right? And I think every couple of years it's announced to be on the chopping block. So no one has a crystal ball, and I can't say that it won't go away, but I can tell you that there was a McKinsey study that put the amount of devastation of getting rid of the 1031 in the hundreds of billions in GDP. And the Biden administration did their own study of the tax savings that it would cause, and it was around 19 billion over 10 years. So it's just not, it makes no financial sense to get rid of it. And thank goodness we have folks like Jeff, not only locally, but also in DC, that once the media frenzies die down, they get into Congress and explain to folks the importance of the 1031. And so far, cool heads have always prevailed. So my assumption is going to be that it's going to continue, because it's in the best interest of not only our economy as a whole, but also to the bank accounts of many of the folks on Congress.
Oh, thank you very much. Yeah, here, Mark can I sell my property directly to the 1031 or DST? So what you need to do is you need to sell your property,
Yeah.
and then the proceeds from that go into a 1031 exchange. So this is a structure, and you could give a little more, kind of walk them through that process just a little bit, what that looks like.
Sure. So the 1031 exchange, it's a tax code that allows for deferment of taxes. It's not an actual entity. The 1031 exchange is a tax code, meaning that when you sell your property, you're allowed to go buy another property and then defer your taxes. So you don't have to pay Uncle Sam right off the bat, and it helps you preserve wealth. Now, I do have a lot of phone calls because not only do we have a DST brokerage and advisor side, K Properties, but we also have a sponsor acquisition side called Cove Capital. Same owners of both companies, do slightly different things. And they oftentimes say, hey, I want to do a 1031 exchange, and I want to buy DSTs with the money I use from the sale of my property. Will you buy my property from me so I can do that? And because sponsors are the companies that put together these DSTs, Cove Capital is a sponsor, they go out and buy properties. So they say, well, why don't you buy my property? And I'll tell you, you do not want sponsors buying your property. They're looking through hundreds and hundreds of properties before they put an offer on one, and they're lowballing everything. So you're better off going to brokers at AOA or somewhere else that's going to take it to market and get you the highest ask possible. And right now, markets are changing. You can't just throw your property on the market anymore, and you're not getting a bidding war overnight. You do need a smart broker, it seems like, from right now to be able to properly market your asset to get the highest price for it.
Great. Okay, here's Benny on YouTube. Hey, Benny, not get to see you, but anyway, I see you there. If I sell my property for, let's say, $2 million, since I've been living in one of the units, can I take out $250 from escrow and leave the rest for 1031 exchange?
Yeah, good question. So I cannot give tax advice, so you'd have to speak with your CPA about your specific situation. But I've done many 1031 exchanges that are very similar to yours. And basically, you're going to do a partial exchange. Speak with your CPA about how you're going to prorate your proceeds and your tax consequence. Part of it is going to go into 1031. And then, like you said, part of it you're going to take out or do something else with. So I think your assessment is right about how you're going in general, how you're going to go about this 1031. Just make sure you speak with your CPA to make sure you get the exact amounts correct and the right amount goes to your qualified intermediary. That's the biggest thing.
All right, Laura, what's your opinion on the fact that a 1031 allows us to only defer taxes? The fact is, we all know taxes will be even higher in the future. Do we gain anything by delaying paying taxes today?
Yeah, good question. So that is definitely a question between you, your CPA, your family, and your financial advisor, right? What are your goals in life? And if you eventually want the cash, then maybe it is a good idea to either cash out now or take a little bit off the table, right? However, I mean, when you talk about capital gains, state federal income, when you're talking about the Obamacare tax of 2.7% potentially in there, I mean, you're talking about, and then the recapture of depreciation, you're talking about potentially a 40% tax consequence. That's a 40% loss right off the bat that you're getting by selling or cashing out of your real estate. And for a lot of people, taking a 40% tax consequence is almost not worth the risk by going into real estate, right? I mean, there's a lot of risk, especially right now with the current political climate, everything going on, and the things that Jeff mentioned. So what a lot of folks do is they continue to defer, they build up, and then there's a couple solutions that I've seen. And this is going a little bit outside my realm, but there's a 721 UPREIT solution. So now DSTs are coming up with an exit plan where sponsors will buy the DST with a REIT. And there's a potential to defer your taxes by going into a REIT. Now, you can't 1031 out of that REIT, but there's often the ability to control your tax consequence by slowly peeling off shares of the REIT over time and netting it against potential losses, the gains against losses elsewhere in your portfolio. So once again, I'm not giving tax advice. Speak to your CPA, tax attorney to see if that's right for you. And also, with real estate, what I've seen that's a potentially good option is either in some of our solutions or other solutions I've seen out there is there's cash out refinance options, depending on where interest rates are. You have a piece of real estate, you've had it over time, you have little or no debt. Sometimes you take out a loan on that property, pull the cash out, the revenue from the property will pay down the interest rate, and then you have that cash tax free. So there's oftentimes we've had solutions like that on our platform as well, right? So that's an ability to access that capital without paying taxes. So long story, here's me making it short for you. That may be a good idea to cash out now. I don't know. But there's other solutions out there that you should probably look into before you pull the trigger on cashing out.
Great. Raquel on YouTube, do DSTs generally break out 1245 tangible personal property and the 1250 real estate property? I need this because I do not want to pay the depreciation recapture on a 1245 property.
Can you help me out with that, Jeff? 1245, 1250.
I don't know those codes either.
Okay. I'm sorry about that. Raquel sounds like a really smart person that I need to talk to figure out what those tax codes are.
So yeah. So sorry about that. I wish I knew too.
Maybe she can drop something in the chat that I can look it up later.
Right.
Educate myself.
Yeah, we have to look it up. Okay, Amy, how are DSTs similar, different from syndicated real estate deals?
Yeah, good question. So DST is a type of syndication. So like an LLC is a syndication, like a REIT is a syndication, a DST is also a syndication. It's an entity where a third party is managing the asset on behalf of investors. Okay. So the DST just has some different benefits and different restrictions that some of your LLCs or funds that you may have invested in the past don't have. So the biggest one, obviously, being 1030, the ability to 1031 into a DST or out of a DST. That's the biggest. There are others. There are other restrictions. And if you want to give me a call or shoot me an email, I'm happy to go over that with you as well.
And, just backing up, like for Raquel, I think maybe more broadly, if we answer, how are, you're cash flowing? And so every year, what type of paper, what type of documentation are you giving to your clients for them to be able to prepare their taxes? That might, a little more of a bird's eye might help a little bit.
Okay. So a lot of times in an LLC, in a fund, you'll get a K1. In a DST, you get a substitute 1099 and a tax packet. It's somewhat similar, but it goes on the Schedule E of your tax return, so you can take depreciation, in the asset and continue to shelter your income if you still have basis. And one of the major differences that you need to look out for between a K1 and a 1099 through a DST is if you have properties in different states that have income taxes, you will probably have to file an income tax in that state. Okay, so it may be important to have a tax going to tax-free states for you. However, if you're in California, we basically have the highest income tax, so it doesn't really matter to us. So I have properties in various states. It doesn't matter to me because I just deduct that income tax against my income tax, and my income tax is higher. But if you're in Nevada or Texas, it may matter for you because you don't have the income tax in those states. So that's one way it may be different that you have to be aware of. Once again, not a CPA. Please speak to your own CPA regarding your specific situation.
All right, here's Mark on YouTube. Can I 1031 my primary residence, or does it have to be one of my rental properties? And you had talked about like kind. So if it's your own property, that's not commercial, it's not producing, it's not investment property. So that's the distinction there that you made. And maybe you could even go in like, the whole concept of 1031, it doesn't have to be a DST. You can buy another property on your own. And so maybe that's another thing to, to help you understand what that would be. And so you can buy another apartment building, or you can buy, self-storage. There's other things that you could buy that would be considered investment property there.
Yeah, perfect. Well said, Jeff.
Okay. Well, I think those are all the questions that we have. If you guys have any more questions, then throw it up there real quick, and we'll have Steve answer it for you. And just again, if you didn't catch the beginning, the $1 Million Trade Show at the Long Beach Convention Center is going to happen on October 27th. So it's going to be exciting to see everybody there. We're going to have Mr. Landlord Jeffrey Taylor there. We're going to have KTS there, Tracy Merrill, Dennis Block, and so many others are going to be there. So it's going to be very, very informative. And of course, you guys are going to be, Cape Properties will be there.
Yeah. Great. I'm looking forward to it.
Right. So here we are. We're getting closer to that. And just about every week we have live streams. So catch us next week. And then also just look, like we have a lot of in-person stuff happening. And I mentioned the RRP course. And so just take a look. The RRP course isn't up yet, but it'll be up within the next week or so. And that will be happening in November in multiple locations. Anyway, thank you everyone for listening. And I guess we'll see you next week. Thank you, Steve.
Yeah, thank you, Jeff.
Okay. See you, everyone. See you guys.